Hi, this is Rosalind Young, and this is my video presentation for Business 103. Enron was established in 1985 by Kenneth Lay. It came about after the merger of two natural gas companies. After some deregulation, it changed into a trading of energy derivatives and contracts, which incentivized closing and making as many deals as quickly as possible. As time continued, they became more and more complex ways of financing and creating the deals. Arthur Andersen Accounting was founded in 1913. What I find interesting was one of the first clients was Anheuser-Schlitz Brewing Company. They are one of the original Big Five accounting firms. They believed in rigorous standings for accounting. They also were one of the first to set up professional development in accounting to make sure that everyone did it to the highest standard possible. Vincent & Elkins is a law firm in Houston. It was founded in 1917. They tied their fortunes to the oil and gas industry of Houston, preferring to find and take even wildcatters as clients, and would accept shares in their companies instead of money as part of their gambling and fortunes. Over time, the financing and bookkeeping at Enron became more and more convoluted, but they were able to cover up this due to the booming 90s. However, after the burst of the dot-com bubble and other means of financing started to dry up, and they started to face competition from other commodities companies, they started to succumb even further to the pressure from shareholders to keep those dividends up, and went from questionable bookkeeping to cooking the books. Two of the ways that Enron used creative accounting to hide losses and create assets was the use of mark-to-market accounting. This would downplay losses while inflate possible earnings in the future. They also used SPEs to hide assets. Some of these were even put together by one of their chief financial officer, who is one of the main people that's supposed to make sure that you're not committing fraud. These SPEs were used to hide all the liabilities to help inflate the growth on their spreadsheet. In a matter of a few short months, Enron went from shares trading at $90 a share down to 75 cents a share. Arthur Andersen's reputation was ruined, and they were facing criminal charges. JP Morgan Chase Bank ended up paying over $2.2 billion in settlements. Vincent & Elkins ended up only having to pay anywhere between $30 to $150 million. All that number was held into is not exactly known. The really sad part to me is all the people who had 401ks who were thinking they were millionaires on paper, who over the course of a month became $10 heirs. As with every recorded scandal in history of the United States, Congress got involved. Luckily, there was some increased regulation that came out of this, mainly the Sarbanes-Oxley Act of 2002, better known as SOX. It regulates what accounting firms must report, that an accounting firm can't be a quote-unquote consultant and the accountant in charge of auditing. It also says that there's harsh penalties for doing things like shredding all the evidence. This brings us to our class. And one of the big things that I think we're seeing in the future of accounting will be the use of AI. We already have KPMG, one of the big five audit account companies, using IBM's Watson. We have things that we use in our own lives, like online QuickBooks, which we might use for personal finances, or I use it for my Uber money. Um, you can even read your financial statements from companies you might want to purchase stock from online and do your own investigations. But the big thing with artificial intelligence is you're looking at something that can go through many, 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 many pages of data and not be pressured into finishing faster or getting it done in a certain amount of time or any of the other things that can cause fraud to occur.